We're going to have a little bit of a chat first, and then Devin is going to give us a bit of a demo and an overview of GammaSwap, some of the existing features, as well as some of the stuff that they're cooking up in the background. And then we'll open it up for questions. So maybe we'll keep the last 15, 20 minutes for questions. And this stuff is going to be a little bit on the more technical side, I think, because Devin is very well versed in everything DeFi with what they're building at GammaSwap. So if there's more technical questions, write them down as we're going through. And yeah, we'll save the last 15, 20 minutes to ask questions, open it to the floor for Devin. So Devin, thank you very much for joining us. Flew in all the way from Miami. We got a little bit of background about you a few minutes ago, but just for a little bit of context, maybe could you tell us, how did you get the crypto bug? What is the background that kind of drove you towards creating GammaSwap, and how did you end up here?
Yeah, that's a good question. So my name is Devin, one of the co-founders of GammaSwap. And then GammaSwap is a protocol that allows people to borrow liquidity from AMMs. But I had been in crypto for quite a while. I heard about crypto actually in college. Someone was telling me about Bitcoin, then Ethereum. I unfortunately didn't invest as much as I should have back then. But I started to learn about it and think about it a little bit more. And then I started my career in Web 2, in like software as a service businesses. And then as COVID came around, I started playing around with DeFi more. And I thought to myself, like, yeah, this is where I think is really interesting. Like now there's not just the infrastructure, but there's applications being built within this industry, decentralized applications that allow people to custody their own assets, earn higher yields. And so I wanted to figure out how I could be a part of it. So I'm based in the US, but I ended up joining a company in Canada that they were the first billion-dollar unicorn in crypto in Canada. They do all the validator infrastructure for proof-of-stake blockchains called Figment. So we would help institutions that had capital, for example, that were holding Ethereum, but didn't know how to set up their own validators. So I was working on the business development, let's say like developer relations side. I was helping judge a hackathon in mid-2022, and I had provided liquidity in a lot of these AMMs and realized that, despite some of these high yields, I was still unprofitable. I was actually losing money, and some things, seemed kind of broken there because in other ways you could be delta neutral. Like if I was earning yield on staking, I could hedge my exposure there on Aave or on a perpetual, but in AMMs, there's no way to do this. And it felt like a big reason that people weren't participating. It was too risky. There was no way for people to really reduce that risk in any meaningful way. And so I met someone, one of my co-founders, who was part of the hackathon building GammaSwap, and I thought what they were doing was really interesting. So I wanted to invest initially, and then they mentioned needing help with BD and marketing, so I ended up joining the team. So I'm the only non-developer on the team now. We've grown to a team of about 8. So we started mid-2022, been live since beginning of 2024. And then, we've been listening to customer feedback, building new products now that are ideally going to be a lot less complex and enable people to get high yields without IL exposure, without having to know how to hedge this stuff, and kind of like these ETF type products that we're really excited for.
Yeah, so we got to connect last night over dinner, and one of the things you just alluded to that we spoke about last night was simplifying a lot of these complex language, coming from traditional finance and different strategies that people can execute on GammaSwap. What are you guys doing? Because I know you said you even feel a barrier for a lot of people entering this space is some of the complexity and the jargon. What are you guys doing to kind of help simplify that, even with some of the newer stuff that you're cooking up under the hood? Could you talk a little bit about that and like why you see that need in the market as well?
Yeah, well, I think a lot of us are advanced here, and so maybe some of us are familiar with some of these concepts. There's also some people who are newer to crypto here as well, and I feel like it's easy to get really deep in technicals without seeing like the longer term vision. And so when I think about crypto, that's, as Lucas was alluding to, only certain people know about that. Even a smaller group of people know about DeFi, smaller group of people know about AMMs, smaller group of people know how to hedge that risk, and maybe a smaller group of people are capable or willing and have the time to do that on something like GammaSwap. Because, even hedging is something I think that's kind of advanced with like Delta 1 exposure, and then with ours, it's kind of like an option. So there's even a lot of funds that don't really do that type of hedging or aren't willing to do that type of hedging. And part of the promise of crypto is that it's democratized, appealable to everyone. And so a lot of retail investors might have like a 9-to-5. They're not doing this full time. They don't have the resources to do these types of trades, or like maybe learn the full scope of what it would require to like execute efficiently. So I think the future of it is kind of like seeing what we've seen in like traditional finance like do really well. And to me, that's like ETFs. They've grown massively. Their product that retail can do very well in. And I think in crypto, we have, the products that have done very well, I think are like ETFs, like liquid staking. DEXs used to be the most like popular category by TVL, and that flipped because a lot of people realize that they're really risky to participate in. So now like liquid staking, super popular, lending, super popular. Like those are probably the highest to like TVL. So all the liquidity is aggregating to like the lower risk products. So and the lower complexity types of products. So the way I see it is the only way that one way that we're actually going to get like DEXs to be as competitive and from a liquidity perspective with centralized exchanges is just de-risking the ability to like participate as a liquidity provider for those. So things like single asset liquidity providing, hedging risk for users, things that basically like track spot, like these liquid staking tokens, like how ETFs do. And so that's the new product we're essentially building. Mm-hmm. It would provide liquidity into concentrated liquidity, AMM, LP, hedge that risk using GammaSwap, and then it provides yield in the token. So you would essentially buy a token, for example, like GETH that tracks ETH, but it has a 20% yield. And so all those fees are collected in the token. So when you sell it, it's worth more, and you just can basically collect that as profit without, I think it's important to do due diligence and know like high level how these things work, but you don't have to be an expert in AMMs or hedging to be able to get that yield. Anyone could participate, and it's completely passive. You don't have to manage liquidation risk, rebalance. It's just there and in that vault, and you can just deposit once you feel like you have a good understanding of the risks and are willing to participate in that type of strategy.
Mm-hmm. Yeah.
All right, so really quick, 20 seconds. Our last in-person UIG live event was so powerful, so many transformations, so much good feedback that we've committed to doing it again, this time in Los Angeles, January 30th to February 1st. And I invite you to at least check out the details. The link will be below. Would love to meet you in person. Would love to talk crypto, DeFi, investing, money, portfolio building, and beyond that, just breaking the mental limitations that so many of us set for ourselves. If you understand the power of community, you're gonna wanna check out this event. Link is in the description.
We're gonna talk and get a little bit more into the strategies and the hedging in a moment when we do the demo, but could you talk us through the journey a little bit more? Like you met your co-founders at this hackathon. You told me last night about the journey of getting funded. You raised some capital. You've continued to evolve the product. You launched your own token. So could you talk through that trajectory and how the vision has maybe changed and what you're working towards for the next couple of years?
Yeah, so I would say for us, we got started with the protocol because we saw this huge risk with providing liquidity in AMMs, and we wanted to figure out a way for people to hedge that. And so I think the part that we're focused on is like how can we make this scalable like to the largest amount of people? And we also see like a huge wave of liquidity, I think, as a lot of us have kind of like talked about in the previous panel, coming into DeFi. So like how can we capture that? Like what products can we build that will help capture that and help make it so anyone could participate in this protocol? So the first version of the protocol we launched was essentially, which is what's available now, is you provide liquidity into a full range AMM, and then you can take different types of like positions from it. So we have like a straddle that is essentially the opposite of like a full range LP, and it starts delta neutral, but the delta increases as the price increases. So it looks like a traditional like option straddle. We have like a long position that's rebalanced to be towards more towards one token. So it gives kind of like perpetual call exposure, and then the opposite for a short. And those positions are also useful for hedging the like one-sided rebalancing of something like Uniswap V3, which concentrates the liquidity, leverages the liquidity compared to something like V2. So you're in higher yields, but you're the rebalancing, the inventory risk you have from the permanent loss is higher. And so it can help hedge that as well. But what we realized as people started to use it is we had some things about the protocol that are good. Like we can support any token since we're not relying on Oracle. But there is some complexity with using it. For example, you have like a variable borrow APR, which is not typical with options. Like typically with an option, you pay an upfront premium, and then your cost is fixed until the expiration. So in ours, it's perpetual, but you're paying the premium basically like every block, every second. And I think that can make it difficult for people to anticipate risk. And then also how nascent like crypto is, and the types of calculations you have to do to even understand like how to hedge a concentrated liquidity MMLP. So we got like good feedback from our users. One, that it was complex and they wanted a product that could automate this for themselves. And after seeing like, we also look a lot to like seeing what protocols are actually growing well. And so the protocols we've seen that have grown well in DeFi are things like Athena, which have democratized like a delta one kind of basis trade between spot and futures. They're like 6 billion in TVL now. Pendle's another one that has been growing well. It offers like fixed rates on yields for different products, which has been something that's really attractive. And also you can also trade the variable yield. So it could be a way to get, potentially more like airdrop exposure if that's what you're considering as part of the yield, or just to get leverage on yield that might be changing for different products. So we saw the success of those, and we were like, okay, we could create something similar to this that does what our users have been asking us for, which is automating the complexity of this. And then the other thing users have told us is, we want something that where we can predict the cost of this a little bit better. So in a version 2, we're also thinking about creating like a fixed premium with more leverage, which is what users want. But we've been lucky. We're almost profitable right now. I think with this new product, we will be able to get into like a strong stage of growth. And we've also been able to raise some funding from, I would say, mostly like liquid funds and angels that have participated in DeFi, because I think they kind of understand this problem like firsthand, and so they knew that there should be some product that eventually solves this, and also understood some things about our mechanism and saw the path we were taking. And I think that helped build confidence with them. So we raised like $2 million almost beginning of 2023, and then we launched the product beginning of 2024, and then we launched our token close to end of 2024, which we've been using also to incentivize some of the liquidity, and we'll continue to incentivize using some of the protocol as well.
Mm-hmm. Awesome. So I know we've got varying degrees of experience in the room. The topic around hedging and being able to hedge away deltas, et cetera, it can be a little bit complex. So could you maybe describe or just break it down in its most simplest terms, maybe for some of the more beginner people here, the problem when it comes to, let's say, perps being delta 1, for example, and why that's a problem that we experience when hedging positions in DeFi with liquidity pools, and how you guys are kind of solving that with the product that you're building?
Yeah, I think there's, I guess to simplify it, so when I mean delta 1, that means it tracks the underlying price. So let's say ETH went from 2,500 to, I'll do a simpler example, 100 to 200. So it goes up 100%. And if you had a delta 1 product with 2x leverage, then you would be, if it goes up 100%, you'd be up 200%. So it's tracking the price movements exactly. And if it goes up 50%, you're still making 2x. If it goes up 100%, you're still making 2x. So no matter how much the price changes, the amount of the instrument you're holding is changing 2 of that. So it's twice what that is, and it stays constant. It's constantly that leverage. But with, so like options, for example, there's like some convexity there. So as the price changes, for example, you'll actually get more leverage. Your delta is changing with the price of the asset, and so that's how AMMs work. It's kind of like selling an option, and as the price of the assets change, you're going to lose. If the price of the assets change more, you're going to lose more. If it only changes a little bit, you're going to lose less. And so that makes it a little bit harder to hedge, because if you're using a product that's tracking the price exactly, then as you get towards the end of those ranges where that risk is increasing, it becomes hard to efficiently hedge out that risk, because the instrument you're using isn't actually like uniform across the curve. You're going to have risks at the tail ends. And also with a lot of these like types of instruments, if someone just launches a new token and there's a pool and it has like a really high yield, that might be enticing to an investor, but because it's new, there might not be a way to hedge that out, because it's not supported by these like Oracle platforms like Chainlink that would allow you to take a derivative position on it. So in GammaSwap, what we do, hopefully not to get too complex, is there's essentially an invariant in the AMM, and that is how the price of the assets are calculated. So in like Uniswap v2, which is the canonical version, the formula is x times y equals k. So the supply of one token times the supply of the second token equals a constant product. And it doesn't depend on the price of the assets. And that constant product grows with fees. And so that's why, like, if you deposit into an AMM, as the price increases of, let's say, like ETH and USDC, you would have less ETH and more USDC, because people are taking that ETH out and giving it more USDC, and then it calculates the price of that, but is always aiming to have that constant product of the two supplies, the K. And so that's actually how we calculate the debt, and that's why we can support any token without risk of market manipulation, because we're using that debt. And so that debt actually doesn't, like I mentioned, doesn't depend on the price. It grows with fees. And so when you borrow a position in GammaSwap, you pay the swap fees an LP position would have earned, plus additional utilization fees. So you don't have actually like a price-based liquidation. You have like time-based liquidations, and it allows you to get hedge exposure to like a much larger range of assets, and in a different type of way, more uniform as well, with how the AMM LP like risk curve changes.
Awesome. I think some of the nuances there will become a little bit clearer when we do the demo in a couple of minutes, for sure.
Hopefully so.
Yeah, hopefully so, exactly. But correct me if I'm wrong, but you guys are pretty much focused on EVM at the moment, and a lot of the liquidity on GammaSwap is on the base network. Can you talk a little bit about the strategic thinking behind that, and the reason for, firstly, maybe focusing on EVM? I think that might be more obvious than also doubling down on base, and what's the line of thinking and how that might change or evolve over time as well.
Yeah, that's a good question. I think like with the next product, we're going to double down on more ecosystems, like especially Ethereum mainnet, because that's where a lot of liquidity is. One of the reasons we're optimistic about Base is I think Base is going to continue to double down like on their ecosystem, and they have a really strong distribution network, from being like the largest centralized exchange in the US, and from just a lot of revenue they can invest in the chain as well. So we've seen a lot of new tokens being created there. We've seen a lot of high yields there, a lot of organic growth of the network compared to other layer 2s. And because it's really cheap to transact on and they're so tightly integrated with Coinbase, we also see a lot of retail flow going there. So we want to be able to capture that in the future. So that was kind of the strategic decision behind doubling down on Base. And then, we want to continue, though, to double down on other L2s we think are growing well, like Arbitrum, and then Ethereum mainnet as well, just because people, although some of the yields are not as high as Base, there's less trust assumptions you have to make. And so some people who are large capital holders are okay paying more in fees or maybe not earning as much yield if they can be on Ethereum mainnet and have, less perceived risk from those trust assumptions they'd have to make on a layer 2.
Yeah, I think a lot of people in this room have probably provided liquidity on Base to some extent. A lot of people using Uniswap or VFAT as an AMM as well, or a yield aggregator. So how do you guys think about other protocols like VFAT? Like, do you see them as competitors? Do you think that there is an opportunity to coexist in the same space? Or, how do you think that GammaSwap is strategically positioning itself to, beat out other competitors in the Base ecosystem? And I'd be curious to hear that.
Yeah, I'm not particularly familiar with that protocol. What I would say is that there are other protocols that are trying to do like similar things to us. And so far what we've seen is we're the only protocol that has allowed people to actually get the opposite exposure impermanent loss, what we call like an impermanent gain, throughout like the curve of assets. So we feel confident in the protocol. I think the thing that we're thinking about the most is how can we make this something that's easy for anyone to use, and understand and participate in, and scale out from there. So that's like our biggest thing. I think generally there's some other protocols that are focused on lowering impermanent loss, but in different ways. So I think different mechanisms for this can coexist, and it's probably a good thing if other protocols are building, because I think the competition helps grow the space. It also brings more attention to the industry, and then also to specific kind of like verticals within the industry. And generally, that's where protocols grow a lot. Like I remember when Uniswap experienced a lot of its growth in 2020, there was also Curve and Balancer, and they all kind of grew together. So I don't, I guess we think less about competition, more just how can we make our products like better for people to use, and where is the industry going in the future? How can we set ourselves up to grow according to where we think the industry will grow?
You mentioned earlier about your excitement around artificial intelligence and what's coming down the pipeline for the crypto ecosystem as a whole. What else right now in DeFi specifically is exciting you? And are you guys executing on strategies or implementing new tech that is kind of riding on whatever you're seeing as the next wave in DeFi?
Yeah, it's a good question. One team that I'm close to, and I think is a really good team of builders that is like grinded through and found product market fit. Some kind of like similar things to us is like Pendle. They took like a huge market on traditional finance, which is like interest rate swaps. I think it's like the largest derivative market in traditional finance, and they did it in DeFi, allowing people to earn like fixed yields and get leverage on variable yields and be able to trade yield. And so they've grown to I think about 5 billion in TVL, and they have a new product. I think that's really exciting. They're calling it Boros. And so it essentially allows you to get like fixed rates on perpetual futures. So it could allow you, instead of having to deal with a variable, perpetual future yield, which could, impact your yield or potentially make it too expensive to hedge to make it worth it, like especially on kind of like larger, more volatile, more long tail, more volatile assets where those rates are actually changing a lot. It allows you to just lock in a fixed rate. So I think that's going to be really good for that type of like Delta One hedging. Also, people could speculate on the yields and get leverage if they have unique insights on where they think like open interest for Bitcoin could go or Ethereum. So it allows people to express their views on the market in a really unique way. So I'm pretty confident in that. And then more high level, I would say, yeah, some of the things that I said before, like yield-bearing assets, RWAs in DeFi, I think are going to be really good. But yeah, I kind of see just a huge wave of things coming, and I think it's going to take some time. But stable coins first, then eventually like yield-bearing assets, and then AI integrating with it. I really just don't see crypto slowing down. I think there will be a lot of opportunities for continued growth in the future. So I'm really excited about that.
Yeah, awesome. So we are going to open it up for questions in a few minutes after the demo, but write them down. I know a lot of the stuff Devin's talking about is on the more technical side, but he is a wealth of knowledge, so definitely want to field some questions. But let's take a 2-minute break. We're just going to move the poster here so we can get the projector set up. So literally 2 minutes and we'll get a demo set up, and Devin's going to talk us through some of the stuff on GammaSwap.